Well, good morning, everybody. Jesse Lipscomb here from Roadmap Tax. I wanted to thank the North San Diego County Realtors for giving us the opportunity to share some tax planning for realtors this morning. This webinar will be recorded and posted on YouTube, posted in about a week if you weren't able to catch all of it. Let's go ahead and get started. The agenda for today, or maybe, excuse me, a little bit about myself. I'm an enrolled agent investment advisor. I specialize in tax planning for real estate agents. We're going to talk about my most successful clients, the Corporate Transparency Act, and the 2023 filing extension that only applies to San Diego County. Okay, so let's talk about my most successful clients. My most successful clients are going to set out to control their taxes by utilizing an S corporation. Now, what that means is an S corporation isn't going to completely eliminate the taxes that you'll pay, but what it will do, it will help you get control of the Social Security and the Medicare taxes. And by the way, for those of you joining us right now, if you have any questions, feel free to ask throughout the presentation. You want to put it in the chat or just want to unmute yourself, either way. Next step, they're going to take the money that they save by setting up the S Corp and they're going to save for retirement, whether they're using 401ks or defined benefit plans or even health savings accounts. They're saving for retirement and lowering their tax brackets at the same time. The next step is they're going to invest for cash flow. Whether you build your business or you use your good income and your good credit to acquire rentals, either way, you've got more money coming in, which allows you to save more money and have more money. So that is, in a nutshell, the three-step process to tax planning. Now, let's dive in much more specifically to each topic. So the first part, controlling and lowering your taxes. The number one tax that you don't even see is Social Security, Medicare taxes, payroll taxes when you're an employee. For every $1,000 you earn, $76.50 is taken right out of your paycheck. What you don't see is you don't see that your employer is matching that. But when you have the intestinal fortitude and you go out and you become self-employed and you're doing the deal and now you're making money, all of a sudden, on your tax return, you'll see the 15.3% self-employment tax on your profits. This is over and above any other income that you make, any other taxes that you are assessed. And in 2024, the 12.4% Social Security portion goes up all the way up to $168,600. So real quick, if you're self-employed, let's figure out how to calculate it. Example, you make $100,000 gross, $72,000 net. The IRS will give you an adjustment and then assess the 15.3% on that. So on $72,000, you're going to pay $10,000 of Social Security Medicare taxes, self-employment tax. When you compare that to an S corporation where you can have both wages and pass through profits, the interesting thing is that only wages are assessed Social Security and Medicare taxes. Your S Corp profits are not. So if you look at it, 24,000 and 48,000 is 72,000, the same 72,000 that you would have made self-employed, but the 15.3% Social Security and Medicare taxes are only applied on the 24 grand in wages. The difference there is $6,500. The importance there is this. I'm going to show you an interesting formula when it comes to saving for retirement. If you take $500 a month at 5% for 20 years, that's $205,000. So the $6,500 annually that you're saving is basically worth to you in the future 200 grand. And when you combine that with the tax savings over 20 years, you'll save $130,000 just in the taxes that you didn't pay. Plus, if you save the savings, have another $200,000. That's a pretty massive swing simply by taking control of your Social Security and Medicare taxes. Okay. The next part of saving for retirement is setting up a 401k. Most people think that you have to be a big business to have one. That's not true. So long as you're a licensed real estate agent, even self-employed, you can set up your own 401k. Um, Interesting about a 401k is that you can be both your own employee and your employer. So you can do salary deferrals plus profit sharing up to 25% of your salary. And in 2023, those numbers would allow you to put as much as $73,000, 73,500 if you're over 50. Okay. Additionally, one of the benefits of having a 401k is you can take a loan out. I'm not saying that real estate agents ever have cash flow issues, but if you did, far better you take out a $50,000 loan from a 401k paying zero tax and paying yourself back over 5 years than taking out $100,000 from an IRA, paying $10,000 in IRS taxes, plus just some penalties, plus typically 24% tax plus 9.3 state. And if you do that math, you'll find that in an IRA distribution, you're losing almost 50,000 in taxes. You might as well borrow 50,000 tax free. A lot of people have a SEP IRA. SEP IRA, nothing wrong with it. But when you compare it to a 401k for a one person operation, you can put a lot more money into your 401k faster than the SEP because you get to be both your own employer and your own employee. So on $72,000 in a SEP, you can put away 18,000 because that's 25% of the 72,000. But with the 401k, you can do the 18,000 plus $30,000 of salary deferrals. That's $48,000 for retirement on just $72,000 of wages. Similarly, if you paid yourself $24,000 a year, a SEP IRA would only let you put away $6,000. You could actually contribute the entire $24,000 to retirement in that scenario. Now, why would somebody do this? Well, a lot of times, real estate agents are dual income households, and the realtor is out there making money, making sales, having fun, but the household income is really dependent upon the W-2 spouse's situation. So if you can not only make the money and then take it all to retirement, that's pretty awesome. The tax brackets, tax bracket planning here, probably the most confusing thing that about taxes. Everybody always hears about AGI. I don't think your adjusted gross income is the most important thing to understand. I think you got to understand, how do you get out of the highest tax brackets? And so here's a quick strategy. If you're single and your taxable income is under $47,000, take a look at Roth IRAs, take a look at Roth conversions. Same thing if you're married under 94,000. If you're going to make over $191,000 single or 388 married or 383 married, you hit the 32, 35, 37% tax brackets. And I think in that situation, it's vitally important to get out of those high tax brackets, because think about it, it's not just 32%, it's 9.3 state. Now you're hitting over 40% of your income being lost to taxes. You might as well be able to put that away for retirement. Speaking of a defined benefit plan, 401k is pretty awesome. You know, you put 150,000 in wages, you've got 27 going in salary deferrals, you got 37,000 in 401k employer contributions, almost 65,000. Pretty awesome. But a defined benefit plan is almost 4 times that, because not only do you get to do the salary deferrals and some 401k employer contributions, but then the defined benefit plan itself is a completely separate plan, completely separate bucket of money that's completely funded by the employer, in which case your corporation. And in this scenario, it really leads to massive tax savings. I mean, $76,000 for literally securing your future. That's a pretty awesome deal. All right, let's talk about investing for cash flow. Um, I believe that building your business, you invest in marketing, you invest in relationships. I think there's a great opportunity there for you to grow and scale and bring in extra income. Additionally, if you want to get rentals over time, you've got that passive income coming in. But the key to understanding investing, from my perspective, is it's a contact sport. It requires you to be able to evaluate the risks, some education, some experience, and most importantly, involvement. And think about it, how much more involved can you be than in managing your own business, right? And managing your own business doesn't mean that you have to have employees. It just means that um, you are in business. So one woman operation corporation, a one man band, however you see it. So we're going kind of fast. My goal is to get everybody out of here by 10:30. But the biggest thing on the horizon this year is the Corporate Transparency Act. Okay, this was passed in 2021. You may have heard of the beneficial ownership reporting requirement, and this applies. There are practically no exceptions for most LLC or people who own corporations, C corps, S corps, whatever. Look, if you incorporated before the end of last year, you have until the end of this year to file. If you set up a new entity in 2024, you have 90 days from the time you incorporate to file this report. And I'll show you what the report is there in a second, but it, it is a hard deadline. It's $500 a day as a penalty, up to $10,000 in additional fines, and up to 2 years in prison for failure to file this. And if you listen to that, it's onerous. Now, interestingly, a court has just ruled the Corporate Transparency Act and this BOI requirement is unconstitutional, specifically to the unduly burden for small businesses. However, this unconstitutionality only applied to the members of the National Small Business Association who brought the lawsuit against the Treasury Department. So for most people, it's still game on. You still have to do it. We expect that the Department of the Treasury will appeal this court's decision. But for right now, let's see what we have to do. And it's irritating in its simplicity, right? FinCEN BOI. We're going to pull this up. Okay, don't fall for the trick. This is somebody trying to get you to go to their site. This is the actual financial crimes enforcement network of the U.S. Department of the Treasury. Once you're here, you click File a Report. Click the top one, and you go here. So most people that set up entities in 2024 will click the initial report. In fact, actually, even if you did it for last year, if you have an existing corporation or a new corporation, it's an initial report either way. But as we go to the next page, this is where some of the information, you really need to understand what it's asking. The reporting company is the entity itself. So if I was doing this on Roadmap Tax Services, I would put Roadmap Tax Services Inc. right there. I would then put in our EIN. I would say that we're from America and the state of formation was California, and our address. Okay. That is the first of three components of this report. It's the reporting company. It's basically what company are you talking about? The company applicants, if you're an existing company, you check this box because it's not needed. If you're a brand new company, you need to put in the name of the corporate founder. Okay. There's an additional requirement here to put the name of the person, the attorney or the tax person that's helped you create the entity. I've seen a little bit of pushback on that. On our side, we give you the FinCEN identifier for us that will help in terms of filing that as a company applicant. But if you're doing it yourself, you just go, first name, last name, address, and then you upload a copy of your driver's license. Okay. Lastly, the beneficial owners is who owns the stock of the company. If you're married in California, this also needs to be your spouse. Well, what if my spouse doesn't have anything to do with my business? It doesn't matter. We're a community property state. Even if your spouse doesn't own your business, it's easy to argue the fact that they have a beneficial ownership interest in your business. Far better to add them than not add them and then be assessed outrageous penalties for failure to submit the information properly. And again, same thing here, first name, last name, address, upload a copy of your driver's license. Then you submit it. Once you submit it, make sure you keep a copy of the transcript that appears once you hit next. That transcript is your proof that you did it. Okay. Last part of the presentation today, we're talking about the 2023 filing extension. San Diego County specifically has a rain delay. And what I mean by that is personal income tax returns due April 15th, even IRA and HSA contributions, estimated tax payments, quarterly payroll Form 941 taxes, S Corp and partnership returns, and even C Corp tax returns now all have until June 17th to file their taxes. Okay. Okay, here's a recap. We talked about the 3-step methodology of my most successful clients, the Corporate Transparency Act, and the 2023 filing extension rain delay. Look at my most successful clients again, controlling and lowering your taxes, saving for retirement, investing for cash flow. They're going to set up an S Corp. They're going to save the savings in 401ks and find benefit plans and HSAs. We're trying to do some tax bracket planning there. Going to use their good income and good credit to invest for cash flow in their small business or via rentals. They're going to make more money. They're going to save more money and have more money. Any of you on the call today or even in the future, if you would like some free articles on tax planning, whether it's tax planning for the self-employed, a tax organizer for realtors, or even the individual 401k, feel free to reach out to us at roadmaptax.com, clientcare@roadmaptax.com for the information. I also can make this presentation available in a PDF if you would like. Really appreciate you guys attending. We're going fast and furious. If you have any questions, feel free to post those in the chat. And otherwise, make it a great day. Much success here in 2024.